But our first session is actually talking about beyond SMAs. And I'm going to be bringing the moderator up to the stage to introduce the panellists. And Toby, I hope you've rested those legs there. And I don't think, Toby, you need an introduction. We all know who you are. So with no further ado, welcome Toby, and then I'll be back to introduce the next session. Thank you.
Thanks very much. We'll be joined today by three people for whom who have been central to the development of managed accounts. Alex Donald is the CEO of Ironbark Investment Solutions. Mike Wright will be known to many of you as the CEO of Lonsec and now the CEO of Evidentia, and Kieran Canavan, CIO of Findex and Centric. So we're joined by three people who bring very different perspectives to the managed account market. But I hesitate to estimate how many years of experience there is between us. But for a relatively young industry, they probably account for most of it. So we're going to start off with the topic that's on everybody's minds and one of the reasons why today turned out to be so successful. Mike, why is Evidentia worth so much?
Good morning, everyone, and great to see so many smiling, familiar faces. I think the reality is the acquisition of Evidentia Group by Generation Development Group was a function of earnings. If you think about the business, it is growing at an incredible rate. It's sort of 5 years young. It printed 12.7 billion in FUM as at the end of December. Its earnings in FY26 is going to be around the 21 million mark. So you can sort of sense this huge hockey stick as you start to get the run rate on the back book. And then frankly, applying an industry multiple of around 15 times EBITDA for enterprise value, you get your 320. I think the trick then is to make sure you're not paying over the odds, particularly with the multiple you land on. We were very fortunate, Toby, to have a lot of reference benchmarks in the market. Generation Development Group the year before had acquired 100% of Lonsec. Now that was done at a forward multiple at 12.4 for the Lonsec group, which included research and managed accounts. As we'd all expect, the research business wasn't as growing as fast as the managed account. It was still growing really well. So from our perspective, it stacked up. If we go back to another transaction in the market of a listed entity, a managed account provider called Explore Wealth, which I sold to Hub24 about 5 years ago, that was at a multiple of 21 times. And if you then compare that to the overseas markets, where particularly personalisation and customisation is getting a huge play, the multiples are all in excess of 20. So we think we've got pretty good value. They're an outstanding team, strategically brilliant opportunity for us to create a really dominant player that's very complementary.
Explore brings back a moment of angst for me because pioneers, having founded that business, pioneers are the people with the arrows in the back. So Kieran, Alex, and without kind of questioning the value of Evidentia, I mean, what does these transactions that Mike has spoken about, Evidentia in particular, tell you about the value that's being created in these outsourced CIO models? What does it tell us about the path of that kind of OCIO model?
So thanks. Lovely to see everybody. I think Mike's alluded to it. I think you can see what's happened here with this transaction, but he's alluded to the overseas market. There are a number of examples of OCIO businesses being bought overseas. There was a large transaction last year by a group called Hightower, who are a very large wealth manager in the US that bought a very large OCIO business for the sort of valuations Mike was talking about. So I think if you're private equity or if you're a strategic buyer as a wealth management firm, I think OCIO businesses show great growth, annuity kind of income. they're kind of like the new fund managers, really. So I think the valuations are appropriate, and I think there's an enormous amount of interest in this space from an acquisition point of view, either from wealth managers or from other OCIO businesses merging together.
Kieran, you've got an outsourced CIO business as a component of Findex.
So look, I think from our perspective, when we look at this, it really validates the model. This helps validate the model from a number of perspectives. It helps people understand and explain what that model actually is, because you can see how it's coming together. It's very similar to what you're seeing overseas, how you bring these component parts together. The other things that are there, it also means better access. If you look at that group combined, the access is going to become substantially better. So I think from our point of view, it's really a validation of the model, and the pricing obviously is correct. But it's great for the industry because it really helps the industry move forward.
So let's just unpick a little more about what do we mean when we say outsource CIO? I mean, what do we mean in terms of the job that advice firms expect it to do, the degree of customization control that they expect to either retain or give up?
Well, Mike's the specialist in this, being the CEO of the biggest one in Australia. But I think ultimately it is for everything that we know asset consultants to do currently, which is, asset allocation, manager selection, managing portfolios. But I think one of the things that Evidentia and Lonsec have demonstrated really well is how important it is to interact with the client, and how important it is to work with advisors through the journey of transitioning to managed accounts, and also that practice management element of the value of managed accounts to the advice practice. But I think the next stage of managed accounts, that's the title of today's session, is what does that then bring? And I think Kieran's point about buying power is enormous. When we start to think about private markets, you start to think about pricing with managers, and the sort of institutionalisation that I think's just about to start happening in managed accounts. That kind of buying power is essential to drive those things, which will ultimately be better for customers.
I think looking at our firm, looking internally, and I look at the functions we have, I think you started mentioning them there, but they include other things such as implementation is super critical, governance overlays, all of those are really important. And when we look at some of our clients within the firm, we see things like family offices, foundations, not-for-profits, already are very familiar with that outsourced CIO type of model. And they may take it and use it in a portfolio construction sort of way, or they may take it in various components. I think what we're seeing through this now is it's coming to, as far as we're concerned, we look at it in the market. It's always been accessed mostly through managed accounts. I think it's getting a new life now when it comes to, because we're getting much better at it ourselves, getting a new life when it comes to personalization, customization, being able to take those models, what is there, combine that with the technology, and then allow advisors and advice practices to personalize that, make sure they have a differentiator with their clients, have a differentiator within their value proposition as well. So I think that OCIO model is changing to support the advisors in a better way, and not just a simple SMA type of function.
Mike, you had the opportunity in the deal to sort of set a structure for Evidentia, for Lonsec, and for the technology piece. So sticking with the Evidentia piece, what is the sort of structure of that in terms of the services that you expect Evidentia to deliver to its clients?
So I might put my Evidentia Group CEO hat on. We look at the market in various segments. So if you can think about the structures that you're referring to, you've got separately managed accounts and managed discretionary accounts. And they're very different structures. One's a product, one's in essence an investment service that comes together through a series of contracts. If you then look at the verticals that go through those two structures, you've got off-the-shelf, ready-made managed accounts, you've got tailored or private licensee managed accounts, and you've got custom managed accounts, whether it's at a practice level or an individual level. So from our perspective as an Evidentia Group, it's how do we support advice firms get the right solution for them and really bring back practice management when it comes to investment. So we're actually very agnostic to the offer that an advice firm will take. If we look at just the Evidentia offer as it is today, they will be the power horse when it comes to the tailored SMA for licensees. That will be in essence, the go-forward offer for the Evidentia Group. But there'll be a series of other offers where Lonsec's currently the number one in each of those categories that we'll continue to provide. So for us, it's super exciting because it's complementary, but we're basically putting advice firms and advisors back in charge of investment decisions for their clients, which we're excited about.
So you started to touch on MDAs there, and Kieran, you run one of the largest MDA programs in the country and have for a long time. But let's talk about the segments that SMAs and MDAs either occupy today or will occupy as we see the advice market evolving.
I think internally what we've done over a period of time in the evolution of managed discretionary accounts within our own business, we look at it, if you look at the business itself, we have 110 officers, well over 100 advisors. The client segments or personas will be everything from small clients on IDPS and superannuation all the way through to ultra-high net wealth family offices, etc. However, when we look at what is the most appropriate way to implement the investments part of the advice, we always find it's either coming down to a managed account or a managed discretionary account. The distinction that we've made, though, is a scale distinction. So with a managed discretionary account, you have the ability to tailor. You can go all the way down to an IMA, or you can do different tailoring. If you don't have scale, a managed discretionary account can be quite expensive to run because you've got a lot of extra compliance, etc. So for the clients that are simpler clients, don't need the tailoring, don't need that sort of functionality, obviously a more an SMA type structure will work there. For a firm of our size, we're sitting with about $11 billion sitting in the managed discretionary accounts. We can run all the clients under that. But our view is that really when you look at all the models that are out there today, the only two appropriate models really going forward will be the managed discretionary account or a managed account.
So Alex, as the RE of the largest RE in the market, I think, with what, over 40 billion?
About 45 billion, yeah.
So when you hear Mike and Kieran talking about the need for customisation and the need for personalisation in advice accounts, what does that, where does that leave you thinking?
I think the chart earlier was a really interesting one, that the MDAs haven't really grown very much, whereas SMAs have grown a lot. And I think that's a reflection of the early adoption of the market segment that probably needs the least tailoring in their offering. And so I think that shows that. I don't see that stopping, and I think that the MDA growth is really going to have to come from those market segments that either need tailoring, or maybe access to things that are less liquid or can't fit in traditionally in an SMA structure. But I think the only thing I would say is that there's a lot of work, and I know we're going to talk about in a minute, about the access points to things that are less liquid and so on that might have facilitated an MDA previously. And I think you're going to see SMAs start to evolve and innovate even further to either introduce tailoring and or private markets. And so I wonder whether that does curtail the growth of MDAs. But look, there's definitely a space for both. And we run an MDA for a private wealth firm that we own. And look, it's an offering we see growing as well because of that tailoring for the high net worth space.
Just to add on to those comments, which I agree with, I think one of the subtlety or the nuances with a managed discretionary offer, as you mentioned, Kieran, there's independent providers like ourselves that provide ready-made, if you like, portfolios on the MDA. Now, why do advisors and groups use those ready-made? For them, it's not so much about the individualisation of the investments. They're happy to continue with the models. It's actually the individualisation of the execution and how they can optimise tax for their clients. So for me, I think I'm a little bit counter to Alex. I actually genuinely feel that there's a renaissance around the corner for managed discretionary accounts. I do think it'll be driven around tax optimisation, private markets, and personalisation of individual portfolios. We also agree that the growth is slower. So if you think about the 15% that we worked with NMG Consulting when we did our commercial DD, there was sort of different speed economies within the managed account market. So the tailored SMA market was closer to 24%. the managed discretionary market was closer to sort of 13%. So at an aggregate book level, it came in at 15%.
Now, there will be opportunities for anybody to ask questions. So if you have a question, we have a roving mic, don't we, Jenny? Yep. So we're happy to take questions as we go. So, I mean, of course, the other point about customisation is that clients actually start from where they are, which is, they start with things they can't sell or don't want to sell, or or things they've had recommended to them. And so customisation is also partly recognising the client's specific circumstances, and an advice firm being able to go, well, this isn't just 70% and I'll do the other 30. It's the service covers the whole spectrum. So, I mean, Alex started to touch on the issues of products, illiquids and ETFs, and those two things seem to me to be two of the most important drivers for the evolution of managed accounts and advice generally, the rise of ETFs. One of the things I didn't put in the chart is that the rise of ETFs as a component of managed accounts continues unabated. And so managed accounts are now account for about 19% of the ETF market. So one of the reasons why we have a great relationship with, BlackRock, BetaShares, and the other ETF issuers is precisely the significance of managed accounts in the ETF market and vice versa. So let's talk about the impact that private market assets, less liquid assets, play in the development of managed accounts, and the way you think they'll be incorporated into either SMAs or MDOs.
Well, we can talk about it from an RE perspective, and I think we're trying to be at the forefront of this. And you mentioned we were one of the first REs, independent REs in the market on all the platforms, and we are trying to drive innovation around this. And the first expression of this we built with the BT Panorama platform. We built a wholesale private markets SMA, which is less liquid.
We've got Katrina
talk about that. Okay, well, I won't steal her thunder. Yeah. But and it's a wonderful product. But we did that for a particular consulting client who saw a need amongst their client base. But it's wholesale only, so it's not under superannuation. It offers anything up to quarterly liquidity within it. But I think the point being, I think a lot of people think putting private markets into a traditional SMA is a difficult thing to do. There are a number of things that are different though. So it's not going to be in the same scheme. So it won't be in the same scheme and intermingled with daily liquid strategies. It'll be in a separate scheme with its own liquidity profile. We've been working really closely with the super trustees of the platforms to deliver this through super. So we're just about to launch on 3 separate platforms under super a monthly liquid private market strategy, which can then sit alongside people's liquid portfolios. So it is a bit of an innovative proposition. The super trustees have been absolutely fantastic about how they're thinking about this. And so BT, I think we launch in the next few months, which is really exciting. But I think that the important things within it will be you have to have professional managers. Yep. Because there is different investment management by the consultant. You're talking about liquidity management, dealing with when do you do trades to match liquidity. Some of the functionality of the platform has to be turned off, rebalancings and so on. So I think there's a technology piece, there's a professional management piece by the asset consultants, and then we're working with our advice groups about what type of client will come into those products. So there won't be any unadvised clients won't come in, and so there'll be there's quite a number of gates and sort of protection levels for the platform and the proposition and the client.
Kieran, I mean, you're going to provide an in-depth insight later on today about the Centric approach, but do you want to give a sort of a once-over lightly?
Yeah, look, I think at a very high level we would say, look, this is fantastic. Getting alternates, private market assets into managed accounts, managed discretionary accounts. Incredibly important because it's an important building block of any portfolio. Especially if you look at, the liquidity premium that you can get out of there. A lot of companies are staying private for a lot longer, so accessing those companies, volatility is lower, etc. So, and also when you look at our industry and you look at public office super, which we see in the platforms, and you look then at industry super has always had access because they manage their portfolios at an omnibus level. They have always had access to early stage infrastructure, privates, all of these wonderful things, and it really does help. It helps from a number of aspects. When you get to public office super, it's a lot more difficult because you have to manage each and every single client at their portfolio level. So we love the idea of it. We've run alts programs on platforms within super since 2018. Some of those are running 700-800 million in them. They've been very purpose-built. I think the one thing is there's a lot of risk that we see within some of the structures. Those are more the individual structures that are used when you're getting access to private assets and not the managed account structures. Where there is, especially assets that are prone to really sit within a structure, whether it's a listed structure or it's a liquid structure, and they tend to trade at large discounts to NAV. That can be problematic, especially if you have to rebalance or you have to get liquidity, or if they trade at a premium to NAV. Both of those, if you're a forced seller or buyer at the wrong time, that can be extremely expensive. The other thing is the learning, and I know everyone was not through the GFC, but one of the learnings from the GFC is that there were products in there that had private assets in them that were marketed as liquid. And there was a very big fund manager in Australia that did that on the private credit side, and it was 90% liquid, 10% illiquid. Clients started getting out through the GFC. It very quickly sort of went to around 97 illiquid, and then they locked the fund for 8 years. So, liquidity when you've got a little cash buffer or you've got a mismatch is very, very difficult to handle in dislocations. So that was all, it's just, buyer beware in there. And I think the structures that Alex is talking about are critical because then people know what they're getting. They're not mixed in with a lot of liquid assets. In those sorts of pools, it's a different scheme. That makes a lot of sense. But you absolutely need these, and we need them to be able to compete with industry funds.
And some of the, if I have an observation about, the GFC and reaching back, it was stuff sold directly to consumers, rather than through advised
Yeah,
channels.
I'm not across that as much. I know within our firm and firms that we have acquired, unfortunately, that was all advised, and they were particularly painful times.
Yeah, and I think product providers have learnt from these periods of illiquidity. I think in the most. And I was at CFS when we closed the Mortgage Income Fund, which was quite a significant undertaking for those very reasons. But if you look at private markets now, the component, Kieran's point's spot on, which is the average advisor competes against an industry fund in their investment solution. They need to get alternatives. They're using alternatives currently. The amount of money that's with Metrics, Australian private credit providers, Hamilton Lane, Partners Group, it's not like we're talking about new things that people aren't using. What we're talking about is taking those portfolios and embedding them in a technology that everyone's already used to and working with the governance regimes around how do you do it. But the product providers largely are now all launching evergreen structures that don't market illiquid product as daily liquid. And I don't think there'll be any of those types of products included in these managed accounts. And the super trustees have been super focused on this issue in the design and build of these things.
I agree with everything that's been said. I think we're probably taking a slightly more cautious approach within the Evidentia Group, particularly for that issue around lockups, and particularly if it goes to potentially the wrong advised clients. So the approach we're taking is sort of multifaceted. There's a unitised structure within the Evidentia Group that we've actually got Ironbark as the RE. We have a sub-manager, Wilshire, who provides us access to global private markets, whether it's equity, real estate, credit, and also support primary, secondary and co-investment. But it's a unitised structure. It's a registered managed investment scheme. It's got sort of minimum ticket size of 25,000, and it's investing indirectly, and it's obviously pooled. So, technically speaking, not a managed account, but we're very comfortable with that approach, particularly for sort of mass affluent retail clients. At the other spectrum, we've spent a lot of time with our client base to develop a managed account offer. The managed account offer that we're about to launch is in partnership with Netwealth and iCapital, and I'll touch on who they are at the moment. It's a wholesale offer, so it's a minimum $500,000 to access this offering. It will be a managed discretionary account that will allow individualisation as you go forward. In terms of the model, the $500,000 initial investment, it will be made up of wholesale Aussie trusts that are Lonsec research across all private markets, including commodities and foreign exchange. But the kicker is the partnership with iCapital. Once an individual gets to $2.5 million, they'll be able to access, if you like, opportunistic deal flow from iCapital. Now, if you're thinking, who is iCapital? Their mission is really simple. How do they bring alternative wholesale structures to high net worth individuals and make it seamless, make it simple, and make it easy? And if you think about the world we live in at the moment, for individuals to access those types of products, they're normally at an institutional or a family office. There's a lot of people doing a lot of administration to make that flow through to get to the end client. So their job is to make it easy. They have a significant amount of deal flow. To your point, Alex, currently on their menu of Evergreen, there's sort of 40 offerings that we can access for our high net worth individuals. Some of them, most of them are actually offshore structures, and that's where Netwealth comes into it. It's all piped into Netwealth, and it's on custody and off custody. So for us, we feel like we're both ends of the spectrum. One is genuinely a managed account, MDA into IMA, and the other's a unitised structure. We're really excited to see where the SMA piece goes with one of our competitors in Ironbark. If that's successful, then we could easily lift the MDA offer and create an SMA for that portfolio.
Yep.
In the last couple of minutes, I want to touch on one of the other, burning issues, I guess, but things that people think about but don't necessarily talk about, and that's ASIC's role in all of this. So what we've seen in the emergence of the managed account space are, either licensee-specific portfolios that have got a margin in them, or licensees that have a related party providing the investment management capability for getting paid for the work they're doing. So let's talk about how we think ASIC might be thinking about this issue of who's getting paid for doing what.
I'm happy to go first. Look, I think our advisors within Findex and Centric, they do fret about this. Our compliance teams do. I do as well. It is fraught, and the regulator should be thinking about it, because whenever there's remuneration and revenue going between advisors, advice groups, products, etc. Two things tend to happen when something goes wrong. One, the optics just look bad. Even if no one's done anything wrong, the optics are bad. And two, there will always be some within an industry that are going to do the wrong thing. So from our perspective, it's a necessary evil that there is conflict. There will always be conflict, I think, in various businesses and business models. It's how do you lessen that? How do you deal with that? Because you can either avoid the conflict or you have to risk manage that conflict. For what we've done as a firm, and it's just our own view, is where there are portfolio construction and management, and we want to take a revenue line for that, we've actually bundled that together with the advice fee. So there's a component that the advisor is charging that is an advice component, and there's a PCNM or portfolio construction and management component. That sort of takes a lot of that risk out because it's going directly to the client. The client is paying it, they're approving it, etc. But as soon as you bring a product in, an in-house product, then that becomes a lot more difficult.
But what about other organisations who don't handle it as an advice, an advice type fee? Mike, Alex?
Well, I mean, I'm happy to comment. I think I think that's the sort of cleanest model, is what I'd say from a regulator point of view, where it is charged as an advice fee, it's subject to fee disclosure and renewal and so on. The vast majority in SMAs don't facilitate a payment to an entity of an advice firm. However, there are a couple of distinct cases, and I think everyone knows who they are. But in all those cases, we've actually helped them with their disclosure, with working with the platforms, with working with the regulator around what is the flow of that portfolio management fee. Has it got any chance of influencing advice? And so on, and so we've done a lot of work on that. I think we've only got 3 structures where that does happen, but they all tend to be in businesses with scale, with genuine separate AFSLs, with a team within it who aren't advice givers, and the flow of revenue to anyone who might be giving advice would be very, very minimal. So that's the hurdle. It is a very high hurdle with all the participants, but as an RE, we are facilitating that payment. And so, therefore, we're subject to pretty strict guidelines about facilitating payments. So,
what about you, Mike? I mean, with licensees or related parties of licensees being paid for the portfolio management?
I think the guys absolutely nailed it. We haven't got too many of those scenarios. One scenario that is quite recent is where we've worked with a partner and a large advice firm, where we've actually appointed the advice firm as the model manager, and they've actually subbed in the Evidentia Group and our partner to support them. We worked with the RE to make sure that was going to get the right outcome. If you think about it, if I reflect on the agreement with the RE and that firm, I think there was 58 obligations that they had to honour. It's expensive to do. They had to have a very strong investment capability, and they had to resource it appropriately. So for me, I sort of looked at the margin, or what they'll be being remunerated for. There didn't feel like there was a lot of profit left, to be honest. It felt like it was actually much more cost recovery, and I felt that was very sensible. So I think it's like anything. It's just making sure you look at each individual case. They clearly were an institutional client. So yeah, I think there's a spot for it for certain advice firms where you can get that very clear distinction.
Okay, we've got time for one question if there are questions in the room. Otherwise, I have one closing question, which is, as far as I'm aware, managed account space has not had any blow-ups. Whereas you look at the unit trust industry and there's plenty. I mean, is it because there's there you go. Exactly. Is it because it's just an inherently more conservative, better structured, more transparent model? Is that why it's gone better so far?
I think from speaking personally, there's a couple of features of a managed discretionary offer that I think really have resulted in not a significant blow-up. I'm like you, Toby, I'm not familiar with any significant blow-ups. So what are the characteristics that I feel make it a very tight offer? The first thing, as an MDA provider and as a part of the contracts, an MDA advisor needs to review the investment program every 13 months. So it's different than sort of ongoing advice. Every 13 months, the investment program needs to be reviewed. Is it fit for purpose for that individual? If the advisor is unable to demonstrate they've had that conversation, then I'm obligated as an MDA provider to give the client the option to either close that down and we specie the assets or sell the assets, or they reignite a conversation with their advisor. So for me, that's actually a really big checkpoint. The second one is, as an independent provider, the foundational SOA around where advice is made around an MDA, we have to check it. Every single SOA, not for the quality of the advice, but to make sure my dear old, grandma Betty's not put into a managed discretionary account that's full of high risk assets. It's sort of just a sanity check, if you like. The other one is today, whether it's independent or licensee, the vast majority of managed discretionary offers are on regulated platforms. So in essence, the regulated platforms have also got their own checks, particularly around product and investment menus. Even though there's not an RE involved, there's still a lot of governance around that. So from my perspective, I think it's a very open conversation. It's constant. The clients tend to be sort of high affluent to high net worth. They look forward to those investment conversations, and it's taken very seriously. So, I think there's some really differentiating characteristics why there hasn't been a blow up.
Any observations?
Toby, from our side, I think, look, there hasn't been any blow-ups, but the ASIC has got EUs out to a couple of firms more through the advice process and how they've done that within managed discretionary accounts. But I think it's exactly as Mike said, there are a number of layers to anyone that's running a managed account or a managed discretionary account. Typically, you've got really good governance structures in there. But if you're running it on a platform, you've got the additional governance layers from the RE on the IDPS side and from the super trustee on the superannuation side that have also got obligations to make sure that they understand what's going on and it's reasonable services are being provided, etc. So I think it's not surprising that we haven't seen those blow-ups either on the managed discretionary side or managed account side, and also within the investment side. I haven't seen any blow-ups on the investment side there.
Look, I think we've had an insightful conversation from three people for whom this is who represent deep knowledge of the development and the future of managed accounts. So please join with me in thanking Kieran, Mike, and Alex.
Thank you.